Varun Beverages is one of India's most compelling FMCG stories. It is an exclusive PepsiCo franchise with a near monopoly in India's underpenetrated beverage market, now overlaid with an early mover Africa strategy. We initiate coverage with a buy rating and a 12-month price target of 485 rupees, implying an 18.8% upside. Our investment thesis rests on 5 structural compounders. First, VBL holds a franchise monopoly as the exclusive PepsiCo bottler across 27 Indian states and 7 UTs, creating a durable structural moat. Second, the Indian market is heavily underpenetrated, with CSD consumption below 10% of US levels, offering decades of volume growth. Third, VBL benefits from the premiumization wave, with energy drinks and low-sugar products growing rapidly. Fourth, Africa provides optionality, covering 14 markets with a revenue base added by the Twiza acquisition. Finally, we anticipate an FCF inflection as the intense capital expenditure cycle is tapering off. Our price target of 485 rupees is based on a blended valuation approach. It gives 50% weight to our discounted cash flow or DCF value of 490 rupees, 30% to our EV to EBITDA peer comps of 475 rupees, and 20% to our PE comps of 486 rupees. Key DCF assumptions include a 12.5% WACC and a 10% terminal growth rate. VBL has demonstrated consistent double-digit growth in both revenue and volume. Total revenue reached 21,685 crore rupees in CY 2025, up 8.4% year-over-year. Volume also grew, reaching 1,238 million cases in CY 2025, reflecting strong organic growth in India and ramp-up in Africa. EBITDA expansion is driven by operating leverage. EBITDA grew from 2,296 crore rupees in CY 2022 to 5,002 crore rupees in CY 2025, maintaining a healthy margin around 23%. This improvement is supported by increased scale and an improving product mix. EPS has grown dramatically, reflecting a 3-year CAGR of 44% from CY 2022 to CY 2025. Furthermore, the business is poised for an FCF inflection. Following a peak CapEx cycle, FCF in CY 2025 stands at 3,200 crore rupees, providing a yield of 2.3% and significant future compounding potential. VBL's balance sheet is conservative, with selective leverage returns. Post-QIP, net debt to EBITDA is only 0.4x. Key assets include PepsiCo franchise rights, valued at 4,200 crore rupees, and significant PPE investments in manufacturing. Ind AS 116 lease liabilities are classified separately from financial debt. Valuation relative to Indian FMCG peers indicates that VBL's PE of 45.3x is generally in line with the peer median. Given its superior revenue growth and structural advantages like the Africa optionality and FCF outlook, this valuation premium is justified. India is the world's largest underpenetrated beverage market. Consumption is less than 10% of US levels. VBL's exclusive PepsiCo franchise covers all 27 states and 7 UTs. The company is actively expanding distribution, targeting a doubling of coverage from 4 million to 8 to 10 million outlets. Africa is VBL's long game, covering 14 countries. The Twiza acquisition provides an immediate revenue base and volume growth. New territories like DRC, Morocco, and Kenya are ramping up, representing significant long-term growth optionality. The Indian macro environment is broadly constructive for VBL. Key indicators include easing CPI inflation and WPI for manufactured products, providing a margin tailwind. India's strong real GDP growth continues to support rising disposable incomes and beverage consumption. Key risks are material but manageable. Franchise renewal, though critical, is low probability due to VBL's global standing with PepsiCo. Monsoon seasonality and Africa FX exposure are monitored via diversification and exchange rates. Debt from acquisitions remains conservative at 0.4x net debt to EBITDA. The shareholding profile shows the promoter group, the RJ Corp and Jaipuria family, holding a stable 59.44%. FIIs and DIIs account for a significant portion of the remaining equity. The key management team brings decades of operational experience, including former PepsiCo India leadership. We recommend tracking key performance indicators, such as India volume growth and EBITDA margin, as quarterly triggers for upgrades or downgrades. The most critical near-term catalyst is the Q2 CY 2026 results, due in July 2026, which covers the peak summer season and is critical for annual EBITDA. This slide provides the audit trail for all data used in this video. Every number is verified through official sources, including BSE, SEBI, RBI, and government bodies like MOSPI. The data was fetched on March 20th, 2026. Please note this is a disclaimer and disclosures slide. This research is for informational and educational purposes only and is not investment advice. Official data sources are cited, and analyst forward estimates are labeled in amber. Past performance does not guarantee future results. Thank you for watching the Value Pick Studies institutional research video on Varun Beverages Limited. We maintain a buy rating with a price target of 485 rupees, implying an 18.8% upside.